Payday loans get all the bad press, but there are a lot of other easy loans that may be even worse. Ted and I have all the scary details, and we're also going to talk about some proposed new government regulations, and it all starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
We all know that here in Ontario, payday loan lenders can charge $15 on every 100 borrowed. Doesn't sound like a big number, but if you get a loan for 2 weeks, you pay back $15 on every 100 borrowed. And if you do that 26 times during the year, that means you've paid $390 in interest on a $100 loan. That's a lot. And that's even a deal because it used to be before they reformed the rules, it was $21 on every 100. Now we have these new fintech companies that are offering installment loans, and the Ontario government is now considering further regulations on alternative lenders. So, lots to discuss. Let's welcome back the guy who loves high-interest loans, Ted Michalos. Welcome back.
I'm not sure love is the right word.
Isn't it nice that we're both wearing our gray Hoyes Michalos?
It's swag. Now, my swag is 5 years old.
There
Yours
you
is
go.
new.
No,
well, 2019.
It's the 2019 model that I'm wearing. So we'll put a link to all our swag in the description, and you can all buy it. So okay, let's get started here. What is a quick installment loan? I mean, that's just a name we've made up. How would that be different than a payday loan?
Well, actually, it's a name that the industry uses to advertise the products as well because they want to make it sound like, oh, this is a nice, easy loan to get. We're very happy. We're very fast. You can get it quickly. The payday loans are designed to be a 2-week turnaround. You take the money, you're going to get paid, or however your income comes in 2 weeks later, you pay it back. Fast and easy. The installment loans are designed to be paid back over a period of time. 3, 6, 9, even 12 months. So they're for larger dollar amounts, but the regulations that they fall under are the regular lending laws, so the usury laws in Canada. So you were saying the payday loans are $15 on 100 every 2 weeks. These guys are limited to 60% annual interest because anything higher than that is criminal in Canada.
That's what the criminal code says.
Right.
So, okay, give me some names of who the guys are that give these kind of loans. So obviously, we're not talking big banks or credit unions.
No, the banks don't do any of this type of business yet. Well, you can
stay
poke
tuned.
me that one for a second. But the biggest providers are probably Easy Financial and a company called Fairstone Financial, and they run television ads. You'll see them all over the place, and it's we'll lend you $15,000 very quickly on one of these installment loans. Access to them is very easy. They're open late hours. They're in convenient retail locations. You can do it all online. The whole trick of these guys is if you need the money, it's easy to get it from them.
And what kind of interest rates are we talking about?
Well, if you're lucky, 29%. Most of them are at 49% or higher. Now, remember, they're limited to that 60%. And the law says it's not just the interest, it's also the insurance and the admin fees that they charge. So you should expect you're getting a loan from Fairstone or Easy Financial that's going to be somewhere between 29 and 39% interest. At least that's what the contract will say.
And so if I was to borrow $5,000 or $10,000 and pay it off over 2, 3, 4 years.
Well, let's do the easy math. $5,000 at 39% over 1 year is just under $2,000 in interest.
In 1 year.
If you do it over 2 years, probably you'll end up paying another $1,200 or $1,300 in that second year. So that $5,000 loan is going to cost you just shy of $9,000.
And if it's over 3 years, then I'm paying more than the original amount in interest and charges.
Certainly are. That's right.
So that's kind of bad. Now, you've already explained that these are easy to get because they're open late. You can do it online.
You can do it in your pajamas while you're eating ice cream, watching the late night movie, right?
Exactly. So it's very convenient.
Not
so
that I've ever done that.
Easier than getting a bank loan.
Right.
Now, we classify these based on the lender type, not the loan type, because that's more difficult to tease out. So we know from our Hoyes Michalos Joe Debtor bankruptcy study that we talked about a couple of weeks ago, that almost half, so 46% of our clients, these are people who filed a bankruptcy or a consumer proposal, have a high interest loan. So either an alternative financial services lender or a payday lender. 28% have at least one loan from an easy lender. 38% have at least one loan from a payday lender. 20% have loans from both types of lenders. And we don't track car title loans specifically, so that's kind of bundled in here. The easy lender has an average loan size of just under $9,000. The Payday lender has an average loan size of around $1,770, but 25% have a loan of $2,500 or bigger. So they are obviously getting into the longer terms. So all those numbers are very expensive. Why then is someone getting one of these really expensive loans?
Well, so first and foremost, people don't go to these guys without having tried somebody else. So the fact that they make it easy, that they're friendly, that their forms aren't complicated, is simply because it's a marketing scam. To once you get in the door, it's a reverse sort of a pressure into what you'd get from a bank. It's hard to get money from a bank. It's easy to get money from these guys. But anyone going to these guys, it's because they don't have access to the money anywhere else. If you could go get a loan at one of the major banks at 7% interest, why the hell would you go to a high interest lender and get it at 39%? It just doesn't make any sense, but it's because you don't have the choice.
Yeah, I've already got other debt, so my credit score isn't great.
Right.
What am I going to do?
Or, we're not seeing as much of this now because of COVID, but the younger folks have a higher propensity to have these loans because they haven't established a credit history. And the seniors have a higher propensity for these loans because they use all of their regular credit first, and then to supplement it, they take on these debts so they can make the payments on the other debts.
And if you're new to Canada, that would be another reason why you don't have the same established credit report. And you mentioned COVID. A lot of banks closed branches during the lockdown periods because, let's force everyone to go online. Right. So the banks themselves didn't close, but they just said, okay, that branch is closed. You got to go to this branch on the other side of the town. Okay, so now you're making it even more difficult for me to transact with a bank.
Well, and on top of that, the bank, there's no way they were going to give you a loan based on CERB or CRB or if you're on EI. These guys are happy to give you a loan on any of those regular income streams.
Yep, anything that they think will be able to get them paid back. So tell me then the cycle that you see in real life. What is the profile of the person getting a loan like this?
So the typical borrower from these guys either has no credit history, so no choice, or they've exhausted all of their other credit. So let's say I've got somebody calls me today. It's a 50-year-old guy that's run up his credit cards. Maybe his income was interrupted because there were some rolling layoffs or hour reductions from COVID, and he just needed a payday loan to get over the hump. Well, as soon as you take the first one, you're stuck because you were short cash. You went and you got $1,000 from this guy. 2 weeks later, you get paid. You pay it back. Now you're short the $1,000 again. In fact, you're short the $1,000 plus another $150 that you paid him in interest. And so you probably have to borrow more. Then you borrow a second one. Sooner or later, they realize they've got 2 or 3 of these on the go, and it's more than they can handle. Their whole paycheck disappears. And so what do? They apply for one of these installment loans to clean up all these payday loans. So that sounds like a smart idea because you're going from, what did we say it was, 390% down to 39%.
Yeah, it's a great deal. 1/10 as much.
The problem is the payments are still coming out on a regular basis. They're still high, and invariably they end up going to yet another one. Or in 3 months, because they've made all their payments, they get an email from the company that lent them saying, would you like to renew your loan? Perhaps you need some more money. And so a loan that maybe started out at $2,500 goes to $5,000. A year later, it goes to $10,000. And now they're in a real pickle.
So all you're doing is postponing the inevitable.
You're not dealing with the problem. You're treating a symptom as opposed to the disease. The disease is something's gone wrong and you don't have the cash flow to support the debts that you have. And so instead of dealing with the debt problem, you incur new debt to make the payments on the old debt, and it just pushes everything down the road. It kicks the can down the road.
Right, and that's why when we look at the numbers of our clients who have a payday loan, the average one has more than 3 of them.
That's right.
Nobody has not nobody, but virtually nobody just has one,
right?
Because of what you just mentioned.
Well, and you can't have one anymore because when they reduced the debt from the interest from $21 on 100 to 15, they said you can't just roll them over and get a new one. So you get a loan from company A. Week 2, you get it from company B to pay off company A. Week 3, you go back to company A. At some point, you've got 2 loans, and then you get a third one. And
that's why in many towns, when you go to the street corner, 3 different corners, there's a payday loan place.
They used to be banks. Now they're payday loan places.
Exactly right, because they know you got to go from one to the other. Now, you just addressed the issue that the government has tightened up the rules.
Sort of.
So the Ontario Payday Loans Act came into effect, I believe, in 2008.
Sounds right.
And they've made further revisions since then. Now, and we already talked about what those revisions were. It used to be $21 on 100 was the cap. Now it's down to 15. You can't roll over. There's a maximum term and so on. But now the government has said, okay, we now understand that these easy lenders, the installment lenders are now getting into this business. So they are considering establishing new protections for users of alternative financial services. This is the name that they've put on them. So alternative financial services are high-cost financial services provided outside of traditional financial institutions like banks and credit cards. The examples being, well, we already talked about payday loans, installment loans, lines of credit, auto title loans, and so on. So currently, Ontario regulates payday lenders. We already talked about that. They are considering doing a comprehensive review of the Consumer Protection Act of 2002, which is the law that governs many personal and household transactions by consumers. The CPA's, and this is, I'm going to quote here.
Right.
I did show prep for this. The CPA's rules support a fair and competitive marketplace where consumers make their own choices without being subject to unfair business practices. Well, who cannot object to that?
What's an unfair business practice?
Well, that's a good question. So we already talked about it. The current Payday Loans Act, they must disclose, and this is something you and I advocated for
years ago,
back before the 2008 amendments. We said, don't just say 15 on 100 because that sounds like 15%. You got to make it an annual interest rate.
And you got to make it clear. You got to hit them over the head with it.
And that's what they have done. Right. There is also a cap of 50% of the borrower's net income per loan. So if my next paycheck is going to be $2,000, the maximum loan's $1,000.
From a lender.
This is from a payday lender.
Right, but you can have multiple payday
lenders.
lenders.
Exactly. So from a lender. I see what you're saying.
That sounded reasonable, right?
Yeah. But if I go to a second one, I hear what you're saying.
Yep.
And then the August 2020 amendments put a 2.5% per month limit on the interest rate charged on payday loans in default, and that's not compounded. Again, sounds great. 2.5% a month.
30%.
Still not a low number. So a payday lender, you already mentioned this, high cost, short duration. So 62 days or less, $1,500 or less.
Right.
An alternative financial services lender, high cost and longer duration. But it's the same rules for if I go and buy a fridge for $1,000 and finance it, no interest deal, or a $10,000 installment loan with a high interest rate. So the Ontario government, Ted, would like your thoughts.
They're just saying that. They don't really want my thoughts.
Well, it's on their website. It says, we would like Ted's thoughts.
Right.
And so if you're watching this, the consultation period goes till the end of March 2021. So if you're watching this in the future, sorry, you've already missed it. They want to create various rules. So one of the things they want to do is regulate high-cost credit. So what is the definition of high-cost credit? In Quebec, they define high cost as more than 22 percentage points above the Bank of Canada bank rate, which is currently pretty close to zero. It's like 0.5% right now.
Right.
Alberta limits it at 32% or more. Ontario is proposing 25 points over the Bank of Canada bank rate. And of course, this wouldn't apply to banks, credit unions, or payday lenders. This is alternative financial services. So what say you to the government? Is this a good idea, a bad idea, specifically with capping the interest rate?
I'm not as concerned with capping the interest rate as I am with clearly letting people understand what the loan is costing them. So there's legislation now that says cost of borrowing has to be clearly disclosed in the documents, but it's not hitting you over the head with it. It's still buried in there. And you and I know, and anybody watching this, nobody reads the damn fine print anymore. You just sign the documents, you get your money, and out you go. You need something that really grabs you. As far as these rules go, I'm a little concerned that it's not going to apply to banks, credit unions, or payday lenders. I think if you want to get a level playing field so that people know what to expect all the time, there ought to be one standard for everyone. And interestingly, any of these rules would apply. So the Quebec 22% over bank rate, there are some credit cards then that would be high interest lenders. Right? Because
That's true.
It's pretty common for bank cards to be at 11, 18, 19, up to 29%. So anything over 20% would fall into these categories. Well, and
certainly a department store card, a gas card, they can have higher interest rates as well.
I think the rules would apply to them. depending on how this stuff is sorting itself out.
Well, and the rules that they've proposed are pretty generic. They haven't actually, we haven't seen the law, so we're not exactly sure how it would apply.
There's no way the banks are going to let it apply to them anyway.
No, and they're going to say, well, we're regulated federally,
right?
So therefore, leave us alone. We don't. This doesn't matter to us. So your idea then is, if you're going to come up with a rule, make it apply to everyone. Right. That makes sense.
My concern with these rules are, so I remember back in the late 80s when I got a new car loan at 19.5% because that's what the bank rate was at the time. So it's saying if you ever have crazy inflation like that, then I guess it's okay for people to be charging 40 or 50% because that's still only 30 points over what the rate was. That doesn't make any sense to me.
Yeah, these rules kind of make sense in a low inflation environment.
Right.
What happens if things change? What about the mandatory cooling off period? So right now, under the Consumer Protection Act, it's a 10-day cooling off period if you buy a timeshare, for example, or join a gym. In Ontario, under the Payday Loans Act, it's a 2-day cooling off period. Meaning, I can go back tomorrow and say, forget it, here's your money back. I don't know if anyone ever does that. I don't know if anyone's even aware of that.
Well, I bet there's no stats on it. But my concern would be, it sounds reasonable, but what's going to happen after you sign the documents and you get the money in your hand that's going to cause you to cool it off? Like, what's going to trigger it? Are you going to get an email that says, these are the interest rates, this is what it's going to cost you? Or is somebody going to call you from a regulatory agency and say, well, you know what that damn loan is costing you? I mean, what's going to change in the 2 days?
Yeah. So, again, sounds good, but...
Right. Practically, it doesn't make any sense.
So what are you advising then?
So what I would like to see is a uniform or a universal document that anytime you're borrowing, anytime you're charged interest for using somebody else's money, clearly discloses the cost of that borrowing, not only the actual cost of the loan, but projected through to an annual rate. I want this to be a simple form on every form of borrowing that you have. So you get a mortgage, bang, this document is on top of the pile. You get a car loan, it's on top of the pile. When you apply for the credit card, it's on top of the pile. When they change your interest rate, it's on top of the pile, so that there's clear disclosure of how much money it's costing you to use this other person's money. That's what interest is. It's the cost of using somebody else's money. And some of these guys, they take advantage of the folks that don't have access to standard forms of credit to charge them ridiculous rates. So I don't have a problem with these companies existing. There's obviously a market for them out there. I just want to be sure that the person taking the loan knows how stupid they're for doing it. I just want you to know what you're going to pay.
Yeah, and in some cases, they feel like they have no choice, so they're going to do what they're going to do. I mean, I've had this discussion with investment advisors many times over the years, because when you go into an investment, you buy a mutual fund or something like that, there's all these forms you got to sign. And again, nobody ever reads them.
Right.
So I've always said the form should be one sentence long, and it should say, you could lose all your money.
There you go. Yep.
What more do you really need to say other than that?
Any prospectus for a new stock or investment, that makes perfect sense to me. This is a gamble.
You could lose all your money. So maybe it's not a gamble, but the downside is you could lose all your money.
Right.
Unless I guess you're doing short hedged options or something, then you could lose more than all of your money. So
you can lose somebody else's money.
We will not be doing a show on GameStop or anything like that. So okay, disclosure is key.
Right.
Now, the counter argument to that is, okay, you got to have the government protecting the people, because even with proper disclosure, I'll give you an example. Food.
Right.
So food has disclosure. It's got to show how many calories and how much fat and sugar and all the rest of it. But we still eat stuff we shouldn't eat.
Yep.
So did disclosure help?
Well, but let's follow your thought then. So the government's going to regulate what you can actually eat. We're going to produce a nice little pudding that has all the nutrients you require. It's going to come out of a spigot. It sounds like the Matrix, I think.
Yes, it does. There's a red pill and a blue pill.
That's right.
Well, and so what this comes down to is a balancing act.
Right.
That, yes, I mean, I kind of like the fact that the government looks at new, drugs and medication and the vaccine and all that to make sure it's not going to kill me. Mm-hmm. I don't think I want a world where, as a consumer, I have to be doing my own testing before I can take some kind of medication. But the flip side is, should I not be informed about what I'm taking as well?
Right.
Should I not understand what the side effects are so that at least I can ask intelligent questions of my doctor?
Use cigarettes as an example. And so I'm equating these high interest loans to somebody smoking 1-pack, 2-pack, 3-packs a day. Now they've got those god-awful pictures on them. I mean, they hit you over the head with, this is not good for you. And people still choose to smoke, and that's their right.
Yep.
But you can't say that they didn't warn you.
Yep. So in that case, now I guess there's a lot less people smoking now than did 50 years ago.
Right.
So perhaps that education has had a big impact. What about seatbelts? There's a law that says you have to wear a seatbelt. So do you wear a seatbelt just because it's the law? Well, some people do, I guess.
Originally, that's the only reason people wore them. It took literally decades to convince people that now you got to have a seatbelt. And I mean, folks younger than us don't even think about it. They won't get in a car. Like, I have old cars.
Yes.
I have cars that don't have seatbelts because they, one's a 1938 MG. They didn't have seatbelts in 1938.
Yep.
So
that's not a car you're driving on the road a whole lot either. You're not commuting to work every day in it.
Definitely
but
not.
You're right. The law was different. I think today it's like, well, okay, it's the law, but I also understand I don't really want my head going through the windshield.
Well, what's going to happen when we get these self-driving autonomous taxis and stuff? Are you going to have to wear seatbelts in those? Like, the structure's going to be different. There's some interesting things coming. But that's another topic for another program.
That's right. We're going to start our podcast on cars.
Seatbelts.
And seatbelts. So I guess my point is there is a balancing act here.
Right. There always is.
And if we say, we're going to let the government entirely handle it, that kind of absolves me of responsibility.
And there's a segment of our population that already feels that way.
Yep. So I don't have to worry about it. The government has obviously figured it out. It's all good. I fall more on the other side, which is, well, I think you should be fully informed and understand what your options are.
The person who's going to take the best care of you is you.
Yep.
Nobody else is as interested in your life as you should be.
And so what I want to have happen is I want consumers to be set up for success.
Right.
So your idea of having one page right on the very front that has a big font.
Big font. Right, and it's going to be simple.
And really simple. The annual interest rate is 39%. I mean, we have it on credit card statements now. If you just make the minimum payment, this is how many years it will take you to pay it off.
Right. So the bank shouldn't mind a suggestion.
It already exists for them, really.
Right.
And you and I know, we talk to a lot of clients and we say, so why did you finally call us? You've had all this debt for many years. It's like, well, I was reading my statement and it's going to be 52 years before I'm paid off this debt.
Right.
And, I'm 60 years old now. I don't know if I'm going to live to be 112 or not. So I'd like to deal with this now.
I mean, one of the marketing thrusts from anybody selling anything these days is, can you afford the payment? They don't tell you what it's costing you. They just want to know, can you afford the payment? This sort of disclosure does away with all that.
Right. I got that high interest loan because the payment is only $200 a paycheck.
I can handle that.
That's easy.
You can't, but
Whereas if you said you're borrowing $5,000, but you're going to pay back $15,000,
right,
then that puts it in different perspective. So on this one-page, bold-faced, big font form, it says the annual interest rate is X, and I guess the second line would be the total payments you will make is Y. Are those the two things you'd have on the form?
And it would be amount borrowed, amount paid back, and the difference. But you'd also, to compensate for loans that are 3 to 6 months, you'd have to be what you're really paying and then showing it as an annualized as well. But there's probably only going to be 6 lines on this page, maybe 7.
Yeah, and even annualizing it, well, that's somewhat artificial. I guess if you have to make it one line, it's the interest rate. If you have to make it 2 lines, the second line is here are the total payments.
Right. Well, it's for things like a payday loan. So you borrow $100, it costs you $15. The problem is then I'm going to borrow $100 again. It's going to cost me another $15. And so I want on that form to show that if I borrowed that $100 for a whole year, I'm paying them $390 in interest.
Right.
So that adds another layer.
Yeah, and I guess that's where the payday loan people, and I know what their argument to that is, they're saying you can't show it as an annual because the guy, it's a two-week loan.
And then we could ask them, produce statistics to show us how many times those loans are rolled over, how many people come back, how long it takes them to pay off the loans.
Yeah, and of course they would say, well, none of them are rolled over. That would be against the law. And this is one of the reasons why they are less inclined to be reporting to the credit bureaus.
Right. Well, that would be the other thing you could do with this form. Like, okay, so that form, you're now adding a section to your credit report, which is payment commitments. And so whenever you get a new loan or borrowing, and one of these forms goes out to the bureau, and there's a section now that says, this is your monthly payment that you've committed to. This is the payment that you're stuck with. Then anybody who wants to see how badly you're overexposed looks at your report and says, oh my God, look at all these regular payments you got to make. And it would scare the hell out of you, the lender, the borrower.
Yeah, and it's really the borrower we're worried about here.
Right.
The problem with that, of course, is credit reports aren't for the benefit of the borrower.
They are not.
They're the benefit of the lender. So we don't want to put anything scary on those because then it might scare borrowers into not borrowing as much.
Right. Well, and the irony of all of this is, of course, if people clean up their finances and stop overspending and stop buying stuff on credit, we'll get thrown into a recession and we'll all be out of work because that's what our economy drives on. So
yeah, which is why this is not a show about macroeconomics. It's a show about the individual person.
Right. We're looking at you. What can you do to make sure you don't get into this kind of trouble? Because these loans are nothing but trouble.
Right. And that's why we advocate having as little debt as possible.
Yep.
Which may not be good for the economy as a whole, but it's good for you.
And make it the right kind of debt. This is the wrong kind of debt. I mean, there's only one thing worse than these payday lenders and these installment loans. And his name's Luigi, and he comes and he sees you every week. And if you don't pay him, something bad happens.
And that's, I guess, one of our other concerns about making the rules so restrictive that you drive this underground.
Yeah, and then we're back to what we used to have. And that wouldn't be good for anybody either.
No. And I don't worry about driving it underground in the sense that it's a guy in a back alley. I worry about driving it out of the province, out of the country, so that it's all online. Because, and frankly, you can get loans online and you're getting them from the Cayman Islands or wherever. Kind of hard to regulate somebody who's not in your jurisdiction.
Right.
And so if they make it too hard to be getting a loan here, then great. We all go on the internet, which is how we're getting all these loans today.
Right.
But we're getting them out of jurisdiction. Now, I understand that if I'm borrowing from somebody in the Cayman Islands, it's going to be kind of hard for them to garnish my wages with an illegal loan when I don't pay. But again, it's a business decision for them. I assume they figure in most cases people are going to pay.
They've figured out a way to do it. Well, and they know what the default rates are on their loans, so it's all math.
Yep. And so they know what they're doing. So, okay, well, final comments.
If you're at the point where you need to turn to one of these high-interest lenders because you've exhausted other lines of credit, you don't have enough history to qualify for more reasonable credit at a bank or other financial institution, perhaps you should be looking at other alternatives. One of them being talking to your accountant, talking to your financial advisor, talk to somebody like you or me. Half the people that contact us really just need to be given some decent advice. The other half require some kind of professional services, but we'll give you the honest answer. I mean, the best referral for us is somebody that says, they told me what I needed to do. I didn't end up doing any work with them, but that person will go and tell 2 or 3 of their friends, and so we'll get the next guy who does need help from us. So
which is exactly why we do this show. We want to get the information out there and at least cause people to take a step back and think, because if we can do that, then we've done our job.
Yep.
Excellent. Ted, thank you very much. My take on this, I think, is pretty obvious. I think government regulations can help. But ultimately, what you sign is your responsibility. You've got to take responsibility for it. So read the fine print until they implement Ted's idea of having the big bold print right on the front page.
They won't.
Which I guess is even more difficult today because everything's being done online and they're sending you stuff in the email and whatnot. But that's, I think, ultimately a big part of the answer. Adequate disclosure, hit people over the head, and provide the information of what the other options are, which again is why we're doing this. If you have to resort to a really high interest loan, then there are probably other and better options. That's really what we're all about. Explore your options. Don't get burned. That's our show for today. Links to everything we talked about are in the show notes over on YouTube and over at hoyes.com. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.